So please appreciate if you limit your number of questions to 2 so that we have more of us participate in this Q&A section. So first one. Okay, you're the fastest. Carl, please.
Thank you very much. This is Carl Chan from JP Morgan. I have 2 questions. My first question is for Duncan, because you are the new chair for REIT. Just curious if you can share a bit more about how you see REIT in, let's say, 5 years' time, and what would be your KPI for REIT? That's my first question. And then the second question is more about the Hong Kong retail sales, because we did see some narrowing in the year-on-year decline in the second quarter. So I was just wondering if you can share a bit more colors on how the trend has been like since October. Do we see more improvement, more stabilization in the Hong Kong tenant sales? And then we're glad to see that we're still able to achieve a positive 0.7% positive rental reversion. But then going forward in the second half, do we expect a similar mildly positive trend, or are we sticking to the previous guidance where we expect a flattish rental reversion in Hong Kong retail? So that would be my second question. Thank you.
Thank you. Thank you. I will hand the second part of the question to Greg, to my left, your right. It's quite interesting. We are in a period of great uncertainty which dictates that we should be cautious in what we do. At the same time, we should evolve the business, which is very different to a revolution of the business. But we should make sure what we do in any analysis is compelling. We need to differentiate ourselves moving forwards. So 3.0 and how that should look from our perspective is we currently have a strong portfolio that's proving more resilient than we thought. But we need to look for new assets to improve the quality of the earning streams in, say, 5 years' time. What that means is we're looking for capital and real estate partners that will invest alongside us into assets that we would want our unit holders to benefit from, but we may not otherwise be able to invest in them as quickly or in an agile manner that we could if we only did it on our balance sheet. So the key word for me with 3.0 is we would want alignment with our new partners and investors, and we would want to be doing things that we should be doing to improve the investment performance for our unit holders alongside those new partners. Yes, we might get paid for doing that on behalf of others, but we will be protecting our balance sheet, and they will be compelling business cases where we see there are low points in the cycle appearing. So would I predict and give you an answer of where we are in 5 years? No. I think some people do, and it suits their investors, but each strategy should be fit for purpose. I think for Link, where we are with our existing portfolio, the best thing that we can be is not to overpromise. It won't be easy. Is to make sure that we're clear, it's compelling, and we're deliberate, and that our strategy is fit for purpose for our shareholders, and they first and foremost benefit from that with a new line. I'll hand to Greg. The second part of your question is clearly tough. I think we've, as George has described, delivered a solid set of results, but clearly those headwinds won't get any fainter, and we are realistic about that, and we have to be deliberate. And again, just as much of the new things we do, the things that we manage currently, there has to be unequivocally compelling business cases for us to invest our capital to get better returns in the future.
I think there was 2 questions in your segment there, Carl, one on sales and the other on reversion. So just on sales, can we go to, I think, slide 17, just for reference, please? So we're clearly outperforming the broader Hong Kong market. So this is something we track quite regularly. The other aspect is this tenant sales index that we've put there from the pre-social unrest. So we're, for 2 of our 3 main categories, we're above the spend or sales at that point in time. And for general retail, we're down. But from a portfolio basis, we're only a very slight, 180 basis points down on the period of 18-19, whereas the Hong Kong market is at 76.7%. So a big difference, and it just shows the purpose and, I guess, positioning of our portfolio and being a non-discretionary focused REIT. The sales performance, I think we're comping lower numbers from the prior corresponding period as we get through the period, so I expect the sales decline for our portfolio to get less. But on the leasing reversion side, I don't think we'll be in a position to preserve that 0.7 position that we've got at the moment. The leasing market is incredibly challenged. The work that our very large and experienced leasing team is undertaking on a day-to-day basis is really challenging. You will have seen from a number of the listed retailers here in Hong Kong that have reported recently with some profit warnings, and that is not going unnoticed. So we'll continue to preserve very meaningful relationships with our retailers. We'll be dealing with each of them on a case-by-case situation, but I would anticipate that the reversions in the second half will deteriorate from the 0.7 that we've reported today, and we'll be focused on preserving our portfolio occupancy. So for us to be able to preserve our occupancy at close to what it was at the full year at March is a very, very good position, and that's our real primary focus at the moment. I will also add, finally, that our occupancy cost at circa 13% across the portfolio puts us in a pretty reasonable position to weather the storm, but working closely with our retailers is what it's all about.
Thank you. Sam?
Thank you very much. Thank you, management, for the presentation, and congrats on the good results. I have two questions, if I may. First is on a follow-up on Hong Kong retail. So on that reversion slowing down point, right, I just wonder what is the right occupancy cost for Hong Kong going forward? Because right now I think occupancy cost is 13.1%. Before, I think at peak it's roughly around 13.5%.
Yep.
So is it structurally we're seeing lower occupancy costs in Hong Kong? So that's the first question. And then secondly, regarding the strategy part, I think more Hong Kong property companies are advocating regionalization and asset-light strategy. So just want to see how you think about the competition in asset sourcing and fundraising in the future. Thank you.
I'll take the question on occupancy cost, and if you look in the presentation materials there, we obviously segment across the four main categories. On a blended portfolio basis, I think anywhere close to 14% is acceptable. The one thing, and I think we spoke about this at the full year, is the one major concern that I have personally is just the erosion of margin for the retailers with increased costs, whether it be labour cost with the increase to the minimum wage, or alternatively just the cost of utilities, and general inflationary pressures is putting pressure on the P&Ls of all of our retailers. So it's a long game that we play. It's a matter of preserving occupancy, and I think you'll see that we would sacrifice a little bit of reversion to preserve portfolio occupancy, and making sure that our retailers are profitable and sustainable.
On the point of strategy, I'll let George expand in just a moment. I think the benefit of the APAC region is it is very, very diverse. A number of its economic cycles as real estate markets move at slightly different times, that they may not be in perfect sync, they're echoes of one another, and it gives us the advantage to improve the quality of our earnings by being in other key markets, so long as those business cases are absolutely compelling. At the risk of repeating myself, it will be evolution for us. We won't believe that we will automatically have a right to go into any new market where there are already good competitors who have been doing it often for over a century. So we will build teams and capability, and we will do it in a measured and careful way.
Well, as we diversify, we're faced with obviously new competitors every time we go to a new sector, a new geography. As Duncan mentioned, both locals and those who go there from elsewhere. That's something that we're quite used to. And but I think in order to prepare ourselves, I mentioned briefly the upgrade of the management team, adding to that capability and continuing adding to that, getting the system ready so that as we piled on more assets for us to manage and analyze, that we do it on an efficient manner. There's a lot more technology from facility management to lease CRM systems and all that we have installed over the last few years. I think those will continue to help us to strengthen the asset management capability that we have. I think these days, especially capital partners that one talks to, and not just looking for someone who will help them to allocate capital, but to help to manage and drive value out of those assets. So those managers who actually have that capability and demonstrated over many years of how to work asset hard will probably get a return of their phone calls. And so hopefully we will be able to deliver on that. The diversification itself is necessary if you look backwards, that if we haven't done it, we would have seen a drop in our distribution already, given the challenge in Hong Kong and China. Going forward, I think what we want to do, make sure is that it's done in an even more methodological way, with a lot more analysis, to make sure that we indeed will be able to deliver that resilient distribution. Not easy, but I think as Duncan have said, we'll tell you more as we deliver. I think we don't want to overpromise. It is a challenging market out there, both on operation and also in fundraising. But we are hopeful, and we're putting together the best team to do that.
Cindy.
Thank you. This is Cindy from Citi. I have two questions. First is as well on your Link 3.0 strategy. Just want to hear your thoughts on what are the biggest bottlenecks in executing this strategy from the time being, and in talking about, say, potential more balanced, optimal portfolio, how do you see Hong Kong's positioning and say, proportion within this strategy? Will be more actively looking for divestment, or how should we think about that? This is the first question. And the second question is for your mentioning on the growth of non-rental income. Just wondering if there's any more color on that. Thank you.
I'll take the first, which may have two or three hidden in it, and I'll hand over to Greg. But it may well be there's also some comments from KS on a Chinese perspective as well for the mainland. Yes, we should look to recycle capital for it to be efficient. That won't be easy, and we will not be in a position where we go through a cycle and we're sellers at the bottom of a cycle. Yes, we will need new capital partners to work alongside our balance sheet to take the new opportunities. So both those steps in 3.0 are hard. There are many good entities, both local REITs as well as international managers, that do that and are very proficient of it. So it's not easy. It's a competitive landscape that's rich. However, if you bring a disciplined approach to sectors, cities, types of assets, you can really benefit from this time in the cycle where polarization is a really key word for what's happening in different sectors, different countries. And it will prove, I believe, in 4 or 5 years' time to have been a good time to be taking advantage of a number of those points in the cycle. Noting, importantly, George's point, you have to also be able to operate those. And that may be a competitive advantage that Link has, because it has a very strong track record in operating assets, which it can dovetail well with its investment management capability. Greg.
On the non-shop or non-traditional income, very early days for us, Cindy. We're exploring a number of opportunities, how we can monetize the common areas of our properties. The amount of footfall that we generate, the style of custom that we deliver through our assets on a day-to-day basis, I think provides us with a pretty unique opportunity to monetize those common areas in a number of different ways. The example that I spoke to today around the solar and the tariff feed-in rates that we're securing is providing a very good return for a very limited investment. We think we can expand that program further. But ultimately, the thing for me in looking at our income streams, our non-rental income or non-traditional income is not a high enough percentage as it should be. So we're working on a number of strategies. It'll take us some time, but the team's very engaged in exploring what we can do to increase our revenue streams.
Thank you. Mark?
Thank you, management. This is Mark Leung from UBS. I have a follow-up question regarding on the non-rental income. Because I look at the first half results, I think the management fee as well as the air conditioning fee was up by around 14 to 15% in this first half. I think, Greg, you mentioned that the many of the retail tenants, they may issue profit warning. Do you think that growth rate will be, that stronger will be sustainable? I think that's the first questions. And also, if we take a part into the occupancy cost, do you think we are, what kind of level are we versus our internal, maybe a ceiling level? What kind of level is it? Thank you.
Okay, so just on the management fee recovery, that's a catch-up, so we weren't recovering our full expense load for the management of the assets, so it's a one-off increase to bring us back to recovery. So we're not looking at extending it again in the near term. And sorry, the second question, Mark, I just didn't catch.
Occupancy.
Right. Yeah, yeah. So again, the base occupancy cost is ultimately sustainable. The other, I guess, lead-in factors that we look at is our reversion rate, our retention rate. Our retention rate's at just under 80%, which is normalised. So all of the lead indicators for us would demonstrate that there is a general affordability to the metrics that we're currently delivering. But as I said in the previous question to Carl, is that the concern is just the overall margins for the retailers are under pressure, and it's something that we have to deal with on a case-by-case situation.
Due to the time limit, we can have 2 more questions. Okay, Griffin.
Hi, this is Praveen Chaudhary from Morgan Stanley. Thank you for taking my question. The first question is about the cap rate. I saw that the cap rate universally has been raised a bit in a market where rates are supposed to go down. So just wanted to understand the outlook for that in future. Obviously, it's an interplay of future rental as well as interest rate, but just wanted to get your thoughts. The second question is more on 3.0. I think, Duncan, you've tried to answer that many times, so maybe you're going to repeat. But the question here is a lot of your competitors are also trying to do the same thing as we have seen. So it's already a very competitive market. We're making it even more competitive. And you're saying that you want to only do it if it's accretive to the unit holders. So you're putting another layer of it. It's not just to grow the asset size, making it even more difficult. What exactly is the differentiating strategy? I understand you manage asset very well, but a lot of your competitors might say that as well. So I'm just thinking, it's been 2-3 years of talking about 3.0. I mean, and we understand it's not revolution, it's evolution. How long do we wait before we see the first instance of, some kind of fee income generation? Thank you.
Okay, I'll hand in a moment to George certainly on the cap rate question. I've got some views, but I'm sure George could easily answer that. If I deal with 3.0, I don't think we should be arrogant to think we're better than other managers out there or any other manager out there. But we do have some longevity in track record of managing intensively operational assets, fixing and improving them and driving earnings forward. That is a compelling business case, and it is hard for competitors to necessarily replicate that aspect of our track record. In addition to that, the new team we have, led by John Saunders on the investment side, has its own track record, which is well established and through the APAC region, and indeed covers many of the target markets that George and others have been talking about today through Japan, Australia, Singapore, etc. So if you're an LP, and I've been both a GP and an LP in the past, you look first and foremost for track record, for differentiation. You'll then look for co-investment which we will be capable of offering, and very much we desire to co-invest because we want to invest in superior assets. And you'll then look to the manager for the science, and not a manager that might just say, I want to grow AUM, or have some sort of misplaced KPI that's not aligned with investors' best interests. And I think dealing with it, picking it in those three ways and dealing with that with integrity is attractive to capital partners because they see what is good for us, we are investing in, and we have track record of doing it. I'm not pretending for one moment there aren't some very strong competitors out there, some of whom have been doing it for a long period of time, but the investment universe is big. The universe is valued, or is the market pricing in many points is at a low point in the cycle. And what most managers want is to have capital to invest as these types of times come in the cycle. It is better to be investing in the next 12 to 24 months than it would have been in the previous 12 to 24 months. And I mentioned that partly in reference to the last part of your question on 3.0 about this having taken some time. I think the discipline that the board, that I can take no credit for, have exercised in care and attention and shown discipline to not invest too early in the cycle is quite good evidence. So in 4 or 5 years' time we'll see, but hopefully that answers the 3.0 part. Cap rates, George.
I'll jump to cap rate, but want to supplement this, tell you a bit of sort of inner secret. As Duncan was saying, just arriving as a chairman, seeing how the board operates, the discipline that we have gone through. Perhaps what is instructional is that we talk about Link 3.0, as you know, for 2 years. You are asking when is the next sort of public step, which will be coming soon, I hope. But we can't talk about it until actually we've done it. But again, this goes back to what I said earlier. We'll tell you more when we've done it. We don't want to overpromise. And if I do it again, maybe I won't tell you 2 years ago and tell you next year. But the point really is it's a long journey because system needs to be ready, documents need to be ready, the team need to be ready, the board need to be ready, our capital partners need to be on our side. All stars need to be aligned in order to make this work. And we told you that we are going into this strategy. We are getting the star aligned, which takes time. It's getting there. Hopefully we'll have more to tell you very soon. So if that's give you a better sort of context and why we are more cautious when we hear other peers to talk more boldly, we would rather just be a bit more cautious. It is a challenging world out there. The cap rate and interest rate, anyone who have been trained as a surveyor will know that they never get the number right. It's difficult, and it is more difficult today than ever before because there is no transaction comparable. So when you do a DCF, normally then you compare it with transaction and see whether it makes sense and all that. And you do a DCF and then you say, well, there's no transaction. There's a distress transaction, and then you say, oh, it's distress, you shouldn't take account of it, or you make a adjustment to it. Then the other point is you look across market. When Australia is trading a much higher cap rate and Hong Kong is at a low cap rate, is Hong Kong overvalued? We don't know. I don't think none of us are that smart in working it out. So there's a focus on making sure that we continue to work on the asset, delivering on the distribution. Valuation is what valuers said, and we hope that the market liquidity will come back soon. You usually see that sort of uncertainty at the turn of the market. I don't know whether we reached the bottom or past the bottom, but we're getting close to it, which is why there is I guess, a lot of contradicting views. And that's usually where the markets start to turn. Exact point, I think we are all betting. But hopefully we'll get it right. But the valuation is what it is. It is very hard to know. But the other thing I would say is we did started to mark down our valuation from COVID. And I think some of our peers haven't done that. We've been quite aggressive in doing so. I think there is still in some market the need to do so. Australia office is one that we still mark down quite a bit. The incentive has been very high. Actually, it's been stabilizing. So maybe there's still a lacking factor on how they do it. So hopefully we're near the bottom as well.
Thank you. Do you have the very last one? Or else I will ask a quick one from the online. So Goldman Sachs Simon asking about update on 3.0. I think we covered most of it. And then the other part is, given your existing 237 billion rental portfolio across Asia, what would be your ideal size of asset management AUM?
Let me take that. The size of AUM is a consequence of getting it right. The objective of an AUM is not necessarily a great KPI for growth's sake. If you invest in the right assets and you drive the earnings growth, you will attract more capital as a consequence. But it is as a consequence of getting step 1 and step 2 right for investors. So we can all be aspirational and talk about target AUM, but I think we need to focus on the process of what will get us the right AUM more than what the final AUM is. All assets under management are not equal. You need to be paid where it's not your capital appropriately. You don't need to raise AUM that's dilutive. And you need to raise AUM that performs. So I would not answer the Goldman question about what the target is. I'd say what we're going to do in the process to achieve that target.
Thank you. So I guess we come to the end of the briefing. So thanks, Chair and the management, for your sharing and the insights. And thanks, everyone, for joining us today. Have a great evening. Thank you.
Thank you.